Joining us right now is Mendon Capital Portfolio Manager Anton Schutz with more on that. Anton, good to see you. Thanks so much for joining us.
Always a pleasure.
So what do you think is wrong? I mean, your thoughts on Diamond's remarks?
Well, I mean, he's right. I mean, every day we get the headlines. I mean, great for the show, because there's always a divisiveness going on out there. But people need to come together. We need to all focus on moving forward. And if you want to put people back to work and create prosperity, you've got to take some of these rules out of play here. I mean, the banking industry has been held back by so many regulations. Liquidity in markets have been held back by so many regulations. And I think it's time to undo some of those things.
Is that partly why you've seen so much consolidation in the business? Because if you can't get growth organically, you acquire growth.
Yeah, no, that's absolutely right.
You can't get growth with all these regulations.
That's been a driver. And, to have economies of scale to be able to pay for all those rules. I mean, all the small banks have been impacted by all these rules trying to govern the big banks. And I think there's going to be a lessening of those rules. And on top of that, not only that, the people implementing the rules are going to be different. They no longer are going to walk into a bank and go, "You're guilty, and I'm going to find it."
Yeah,
well, right. At times, too, a lot of banks wanted to avoid growth due to the fact that once they hit a certain threshold, then they have even more compliance. Where they and if you look at the compliance departments, they're the ones that have grown, and they're a non-revenue generating part of the bank, right? So all those resources were put there instead of lending and actually fostering growth for the U.S. economy. So how do you think the Dodd-Frank is going to play out with this new administration? There's talking about pulling it back. There's over 22,000 pages of rules and regulations from an alphabet soup of agencies, from the CFPB to the SEC to everywhere. So how do you think it's going to play out in this new administration?
Well, I mean, what Jamie Dimon can't say, but I have on good forces, is 40,000 pages in CCAR submissions a couple of years ago. 40,000 pages. What regulator is actually reading that and understanding it? Right. I mean, how many people are employed to put that document together? At $10 billion in size.
And the CCAR is when basically they're telling you just to evaluate the bank based on the capital that they're holding.
Right.
And then they're going to allow you to either pay out dividends or not.
Yeah, there's so much that goes into it, but it's basically a stress test on the bank and its ability to survive. I mean, at $10 billion in size, a bank now has to receive less from payments when people swipe their debit cards. That's the Durbin Amendment. Yeah. Really? That was a transfer from the banks to the retailers. What did that do to help make the system better? I mean, that's completely arbitrary.
So there's a law in place that...
That's the Durbin Amendment. The
Durbin Amendment that takes money away from the bank and gives it to the retailer.
Right, and the consumer didn't benefit, the retailers benefited.
It's the merchant swiping aspect of it, so it played its way into the processing, and that's the problem with Dodd-Frank, right? I mean, it was a big bill, and then it gave all these government agencies carte blanche to issue all these rules, and that's why we have over 22,000 pages, and they haven't enacted everything, and it's hampered the growth. And going back to it, too, tax policies have had a huge impact. And one of the things that Jamie Dimon's hit on is said that companies are spending an onerous amount of time, energy, and effort fostering overseas development and trying to figure out how they go over there. And so he thinks the U.S. needs to come down on tax policy, which was a big thing that he highlighted.
I mean, think of that $3 trillion offshore, right? I don't care what you tax it at, but we can get some of that revenue back. We can put some rules in place to encourage people to hire people. I mean, the critics say, companies are going to pay dividends and buybacks. Well, that's not terrible, but okay, let's create some jobs out of it. Let's tax it at 5 or 10%. Hey, that's another $300 billion in our pockets.
And they did the stock buybacks.
That's what he's trying to do, Dagan. That's exactly what he's trying to do.
That's part of the plan. They just need to act on it. And again, that's the roadway to infrastructure spending. Essentially, is that's how you come up with the money to spend on fixing our roads and bridges in this nation. And because it could be about $250 billion at a minimum.
Oh, sure.
Right?
Sure.
And what's really interesting about his letter, too, is he talks about education a lot. He talks about failing schools. He talks about inner city schools, high school and vocational schools. Because if you're really trying to look long term in the health of the economy, you've got to start there. And so, what is your optimism insofar as the administration here? Because with school choice and Secretary DeVos, I mean, there's a totally different philosophy on education here. Is that something also that this sector is looking at for hope?
I think that if you look at what's threatening this country so much, it's our education system. I think we're not turning out people out of our high schools, getting them ready to go to college, and they're not set to thrive in life. I mean, they're not hireable. I mean, we need to get those people.
Yeah, I'm glad he talked about that.
They don't have the skill sets.
Right.
They don't have the. Can we talk about earnings, please? Because they're about to be reporting next week. Let's get into the banks, because this is what you do. And your fund is just doing so well. Congratulations. $1.1 billion in assets under management at this point. J.P. Morgan reports earnings next week.
Right.
What are you expecting from the earnings out of the banks?
So, you know, we've had the Fed raise rates. We've raised rates a few times. It's going to show up in margin. Margin will look better across the industry for the most part. Loan growth is sort of one of those things that we haven't seen materialize enough. And by the way, with rates still being low, a lot of companies have rushed to market to issue bonds. So when you look at bank balance sheets, they're not as big as perhaps they'd like them to be. Loan growth hasn't been as spectacular as they'd like it to be. I think we still need some more stimulus in this economy to get it going. But I think that's the one bugaboo in bank earnings. They're going to look at loan growth and go, well, it's not quite there. But I think margin will look quite good. You know, I think the capital markets will be mixed, I mean, in terms of comparison to last year. But the thing that's really interesting, that you're out there, if I go to a bank conference, people are very confident. They feel really good. You go back to the crisis, and it was like attending a wake.
Oh, yeah. Well, and you know what? Your assets under management actually speaks to that.
It does.
That people have recovered from the fear of owning bank stocks because, you know, in 2008, a lot of moms and dads got wiped out. They owned nice dividend yield bank stocks that from 50 years ago. There was like a bank had been bought and bought and bought and bought and bought. The fact that your assets are where they are shows a real confidence and a real desire to hold these names, and that goes a long way.
Thank you. Well, you know what's really interesting is there's $46 billion in financial ETFs out there.
Wow.
$12 billion has been added since the election.
Wow.
So, you know, people have taken a position not in individual banks. They've taken a position in funds like mine or in an ETF type of structure.
Just to get the exposure.
Just to get the exposure. The other thing that's really interesting is from a buyback perspective, I think with all the excess capital in the industry, when we see the CCAR results, we're going to see, you know, 20 to 30% more in payouts among the big banks.
Payouts meaning dividend payouts.
Dividends and buybacks.
Increasing.
When are we going to get that? When does that come out? June?
Yep.
Okay.
And, you know, the number could approach, you know, $100 billion.
That's what you're saying. You're saying with the underperformance in the first quarter, buy now. While supplies last.
But we need to focus, when banks come out with their earnings, we need to focus on their earnings guidance and what they give going forward, because they were really tempered expectations last quarter. And we have not seen financial deregulation. We have not seen tax policy. I think the banks will be really muted, and that could hamper their performance because they are not going to want to overpromise and underdeliver.
Sounds like you don't want to buy the banks ahead of the
I would not buy the banks here because we haven't gotten those catalysts yet.
And you said the same thing. You said loan growth's just okay.
Right.
You know, you said that it's not going to look great. So capital markets is not going to look great. So you wouldn't buy the banks either ahead of
Well, you know,
I know you own a lot of banks, obviously.
The way I like to buy banks are banks that have catalysts, banks that can create earnings, can, you know, buy other banks, hire other people. You know, Pinnacle Bank in Tennessee is going to have 80 new lenders onto its $20 billion bank. They just bought Bank of North Carolina. Home Bank just did a smart deal in Florida where they bought Stonegate. Deal's immediately accretive to book value, immediately accretive to earnings. The Pinnacle Bank North Carolina was the same kind of deal. Smart deals like that create value for shareholders, and those are the kind of banks that I want to own.
And there's still a lot of banks out there to buy,
Still lots of them.
which could get acquired.